Hello from Trend Signal for our review of the data and events the week beginning the 2nd of March. Start of another new month in 2015, already March. And the start of a new month means non-farm payroll data or US employment or unemployment, depending which way you look at it, plus a whole lot of other data as well this week. It is the start of Eurozone QE at 60 billion euros per month of bond purchases until 2016, with the aim of lifting inflation back towards the ECB's 2% target. Although Mario Draghi has been fairly coy about when these purchases will start, but at 60 billion a month, they would have to start fairly soon, perhaps after the ECB's monetary policy meeting, which has been held in Cyprus this week. Overnight news on Monday morning from the Far East, Chinese rate cut. We see this on the front page of the Financial Times. That set the early tone for equity markets in the Eurozone, which are quite positive. Bond markets sort of mixed, and obviously the US dollar still riding on an 11-year high, certainly the dollar indexes anyway. The positive move for the US dollar, that was actually sparked last Thursday by slightly better core inflation data in the US. And the inflation data highlights the different phases that the US and Eurozone economies are in. And I think that's really taken over as the dominant theme in the markets from the Greek or Grexit talks and the renegotiation of their debt. And also Ukraine, they're very much off the radar now. And it's the policy differences between the Eurozone and the US that are really in everyone's focus at the moment. The Federal Reserve in the US is probably within 3 months possibly of raising rates for the first time for several years, whilst the Eurozone is battling deflation and weak growth and is embarking on a QE program, the like of which happened in the US, as I say, several years ago. The Eurozone data last week was mixed, although it has been fairly positive as conditions improve. Certainly the cut in oil prices is having its effect, not just the deflationary effects, but positive effects on consumer spending and the like. Although the German IFO Business Climate Index did fall short last week, but there was better inflation data out of Germany and Spain to counter that. So as I said, it's really Brexit and Ukraine. They seem to be off the radar for now. It's all about this policy divergence, which is the main theme. Although events in Moscow perhaps did more to promote what Boris Nemtsov, the chap who's assassinated, there'd been probably larger protests about that than any protests that he was planning. But Putin, I suspect, will deal with this in the way that he deals with any other opposition parties of late. Overnight news, as I said, the People's Bank of China cuts rate again. That's a second cut, I should say, in 3 months, cutting their rates to 5.35%. The cut is in reaction to the threat of deflation and to help spur growth. As is the usual way, the main beneficiary was the ASX in Australia, which is often regarded as a proxy for China. The mining and materials sector rallied some 1.5% on the news, pushing up the ASX at 0.7%. So data and events this week, we got a very, very busy schedule with a lot of high impact data releases here, as shown on our Forex Factory calendar. We only have the high impact ones highlighted. We've got a number of monetary policy meetings in the Eurozone, UK, Australia and Canada, not to mention quite a few manufacturing and service sector PMIs out in Europe, US and China, and also the main event being the non-farm payroll or the employment data. So let's just have a look at that. I'm just going to go through the key ones really. We're going to jump to Tuesday. We do have manufacturing out in the US. A lot of these PMI out in the US. We've already had the Chinese one. They seem to be matching or beating expectations. But I just want to have a look at the Reserve Bank of Australia monetary policy meeting overnight. We'll get the news on Tuesday morning, but there's a strong chance that the Reserve Bank of Australia will cut rates again this time round from 2.25% to 2%. They cut them from 2.5% to 2.25% previously. That's probably 60% discounted, but it will be a little bit of a surprise if they do cut. Likewise, if they don't, you could see the Aussie recover somewhat. The next major event, really, and being the non-farm payroll week, is to focus on the ADP non-farm employment change, and that data is released at 1:15 on Wednesday. That'll give us a pointer towards the Bureau of Labour Statistics data that comes out on Friday lunchtime at 1:30. Again, the US labour market looking pretty solid, quite frankly. 219,000 jobs. That'll it's a little bit volatile, the ADP, but that will be fairly well received. We have the non-manufacturing PMI out in the States on Wednesday afternoon, and then Thursday, probably the second most important day of the week, we have our own MPC meeting here in the UK, the Monetary Policy Committee, with inflation dropping sharply to 0.3% in January. It is highly unlikely that we're going to get any dissenters on the Monetary Policy Committee, so we expect a unanimous vote to keep rates unchanged again for the 72nd month in a row, which is extraordinary. However, there was talk about the need to raise rates sooner rather than later if inflationary expectations do recover, which is what Martin Wheel of the BOE seems to think will happen. But the main event really on Thursday will be the announcement from the European Central Bank. We're not expecting any rate cut, of course, so nothing will happen at 12:45. But the press conference always turns out to be quite a lively affair, and we don't expect any difference this time round with Mario Draghi, the president of the ECB, talking about Greece and the negotiations there, how he sees inflation changing, the oil price effect on inflation, and obviously his hopes for growth in the Eurozone economy as the effects of the Eurozone quantitative easing take place. So 1:30, that would be quite a lively affair. That will have an effect on all markets, whether they be equity, bond, foreign exchange markets. And then the main event of the week on Friday is the non-farm employment change in the Eurozone, in the US, I should say. We're expecting a fairly healthy 241,000. The labour market remains pretty buoyant. I don't expect to have too many shocks there, with the unemployment dipping actually from 5.7 to 5.6%. As I say, I think it's highly likely, if these numbers remain as expected, that we are going to be seeing the first rate rise in the US come June. That's it. Thank you very much for listening. Good luck with the rest of the week. Bye for now.